the Goldmine Podcast.
Kind of walk me through, because now you're in the last decade, really, you've had, you said over 200 sponsors that you've kind of helped with in some capacity.
Yeah. So I've helped, guys who come and say, I don't have a pooled fund. I want a pooled fund. I've helped, it's probably 220 of them now go from not having a fund to having a fund that they could go to market with.
What would you say for an emerging fund manager like that? What would you say the three most important, but like overlooked things that you need to have in order to be a legitimate player in like the fund space? Like what are some of the important tangible things that you should have that maybe are like often overlooked?
Yeah, I mean, I don't know if they're overlooked, but I mean, number one is just you sort of have the tiger by the tail as it pertains to deal flow. So your strategy is very clear in your mind and your ability to source transactions that fit inside your buy box. I think that's a must in order for a fund to work, right? Meaning that you can do enough of those transactions. I mean, some of the other things, that you have to have is, you have to have some amount of maturation where you've been able to get traction, doing syndicated deals, right? Where, because I always say the same thing, you have to earn the right to manage discretionary capital, right? So like you have to hey, you've syndicated 5 deals, 10 deals, 15 deals in a 1-by-1 basis. But because your deal flow is so strong, it's not the most efficient, effective way to capitalize your deal flow. So I think those are the big things that I look at, because it's certainly more difficult to raise capital into a pooled vehicle because you're asking the investor to completely abdicate the decision making, right? Like they don't get to pick which deals they go into. And then there's just certain strategies that just a fund is really the only way to go. Like private lending would be a great example. If you're originating $500,000, $1 million loans, fractionalizing loans or, finding investors and matching them is just completely inefficient, doesn't make sense. So we had a lot of people who were private lenders who were turning up debt funds as an example. Those are the big things. I always say deal flow is everything, right? So the more clarity you have about how you source those transactions, just a lot of conviction around your strategy. And the more narrow it is, I think it's just easier to raise. If you have a really broad mandate, meaning, hey, we do this and we do this and we do it everywhere, that's not a great formula for, trying to raise money into a blind pool fund.
Yeah, it makes a lot of sense. Now, for sponsors of like an emerging fund manager, are you seeing a lot of these guys, or did you see a lot of them that were coming in having never done like the brokerage guys that you're talking about, right? Are they going straight from brokerage to fund management, or is there like a middle step there where they've syndicated a couple of deals and then they're getting into like the fund space?
Yeah, no, they've usually had syndicated a few deals, and a lot of people, the sort of half step is, there's no one size fits all, right? So this is the other thing I try to explain to people, is that the fund is just a vehicle, right? It's just one component of your overall capitalization strategy. So, what one interim step, right, is just to have the pooled fund that's more of like your GP co-invest fund, meaning the fund is only going to represent 10% minimum, 20, 25% of all the equity required to do deals. And you may still continue to syndicate the remainder of the equity, or you may do, 90-10 joint ventures with, other single large check writers, right? They come in with 90% of the equity and then you bring in the 10. So it's just, that's how I've always looked at it. It's like, it allows you to be more having the fund and starting one sooner rather than later when appropriate, just makes sense. Because the other thing that a lot of people hold against you is like, well, you've never managed a fund before, right? So it's a chicken and the egg problem. Mm-hmm. Well, I can't invest your fund because you've never been a fund manager. Well, if no one ever invests a fund, how can I ever become a fund manager? So I think that's a better way. Now, and the way that you do that is that you provide those friends and family and those who already know, like, and trust you with closer to GP economics, right? So you say, hey, come into this fund and you're going to get, a portion of the promote that we get off of the gated LPs or whatever. That's just a great way to kind of get started. And the fund size might be $5 million for like a real estate operator, or maybe 10 million. So a smaller fund size, but just starting small so that you can kind of build that up. Be like, okay, well, we did fund one, get that done, and then do the fund two. And maybe someday you get to the point where all of your LP capital is coming from the high net worth channel, and 100% of the equity, the fund owns 100% of the equity in every single deal you do. That'd be great. But that you don't start there.